All right, welcome back, everybody. It's my pleasure to introduce our next guest, Justin Nielsen, who is the IBD Stock Market Research Director. He's also an Excel expert and also the longtime assistant to William O'Neill himself. Justin, thank you so much for taking the time and welcome.
Hey, thanks, Richard. It's good to be here. So I'm actually coming to you from a hotel room in Houston. I'm traveling. I had a trader summit today for Investors Business Daily, and it was funny because a lot of people were actually coming up to me and saying how they were looking at the TraderLion conference last weekend, and they were just really enjoying the stuff that they were seeing. I mean, it's, and Amy Smith is out here with me too. So of course she was on last weekend, and I mean, what a great lineup. I can't wait to see some of this myself. I've been busy the last 2 weekends, so I haven't gotten to see some of the other speakers, but I'm looking forward to that. Just a little background on who I am and where I came from. I've been working for Investors Business Daily now since 1997. I started in customer service, didn't know a thing about the stock market. Folks, I am an anthropology major. This is not what I thought I was going to be doing with my life. So, what happened was I was planning on getting a year start in the business world, and 1 year turned into 2. And then Bill O'Neill, the founder of Investors Business Daily, kind of brought me out to lunch one day. I was working on a project. I brought all my paperwork to kind of show him what was going on with a project. And he said, hey, would you like to be my assistant? So that 2 years has now turned into kind of 25. One of the best things I got to do working for Bill as his assistant was help him build his presentations. I moved him from the old overhead projector into PowerPoint slides, and kind of started going live on things. And of course, also helping him with the book, How to Make Money in Stocks, both the 3rd and 4th edition. Of course, back then, Ross was working for William O'Neill, so I got to hang out with Ross for a bit while he was a portfolio manager. When he was starting to speak, kind of get him up and rolling, and I was kind of his support in the back, helping him with his presentations and everything like that. So a lot of great experience working in this place, and I hope to share some of that knowledge with you today. So just kind of taking a look at one of the things I'm going to be talking about is really kind of the market overall, follow through days and power trends. And I just want to kind of give you a little background on where this came from. We kind of had this market school project. We decided we were going to do a quick little webinar, a new seminar that we were going to do. And it was going to talk about the history of the market, and we were going to show examples. Well, as we were coming up with all these examples, we started doing comparisons of things, and we started kind of trying to come up with rules. We sat down with Bill, and by the way, when I say we, this is Charles Harris, who was one of the portfolio managers, and Mike Webster, another portfolio manager at the time. So the 3 of us sat down, we got Bill O'Neill in a room, and we were just kind of pestering him with, follow through days, distribution days, and just kind of really trying to nail him down, because sometimes that guy could bob and weave a lot. He would, you try and nail him down on what exactly, made it the difference between a stalling day here and a stalling day that wasn't called here, a follow through day that was called here and not here. So we really tried to kind of get those nuances down. And as we did that, I started putting this stuff in Excel, and I started checking, because it's one thing to, kind of do this stuff at the bottom, right? And say, oh, I see a follow through day at the bottom, but I started doing it and just checking everywhere. When did you get these clusters of distribution, that window of 5 to 6 distribution days over a 4 to 5 week period? How often did that happen during a run? And so as I started doing more and more of this in Excel, we started coming up with more and more rules that kind of told us when you should be increasing exposure and when you should be backing away a little bit. And by the end of this, it turned into this monster where we were no longer kind of just looking at the history of the market, but kind of coming up with automated rules to kind of match how Bill did his investing. So again, this automated system of market analysis, and we just basically started kind of doing a cumulative tally of signals for market exposure. Okay, you get a signal here, you add exposure, you get a sell signal here, you decrease exposure. Most of our focus was on the NASDAQ composite, because that's where a lot of the growth names have been for the last couple decades that I've been at the company. And when we were doing our testing, we didn't use margin or shorting. Those were always things that we wanted to add later on, but for the purposes of our data analysis, we didn't use those. But again, we're still kind of holding out hope that one day we can do that. So a few of the things that I'm going to talk about today, I'm going to get a little bit back to the basics about this follow through day. And in doing so, I'm going to help walk you through some of the defining of terms, because there's a lot of nuances there. And some of the things that Bill wrote in the book, what he did in practice was sometimes a little bit different. And you have to understand that he was very rules-based, but he was also full of exceptions. There would always be, yes, this is the rule, but there's an exception here. When you see this special case or these special cases, you might want to do something different. And a lot of that was just based on his experience. So we really tried to get into his head a little bit and find out how we could, do something that kind of put that experience into Excel. Now, of course, the problem is some of these nuances with Excel, it's black and white. It either hits it or it doesn't, where sometimes it felt like, oh, well, that kind of deserves a, maybe not a full point, but a half a point. And or there were there were things where, distribution, for instance, and just a little quick story here. Mike, Charles, and I, we were kind of trying to improve the distribution day concept. And we came up with 20 different types of distribution day, because, there's some days where it closes in the upper part of the range and it's support and doesn't look like distribution. So we came up with all of these different rules. We showed it to Bill. We were so proud of ourselves. And he's like, oh my gosh, what did you guys do? You made it too complicated. So, so we were really trying to kind of get this balance of not making things too complicated, but also getting into that nuance, because it's not easy. There's a lot of different things that come into play when you're talking about analyzing the market. And it's not just checkers, it's three-dimensional chess. There's all of these different things that you have to look at on different playing fields, and it's not just one area that you're looking at. So we're going to talk a little bit about those nuances. In fact, we'll talk about some of the things about indexes to use, downtrends, the power of the follow-through day itself, or the volume behind it, success and failure, individual stocks, how those come into play. And then we'll kind of wrap it up with a quick discussion on the power trend, something that we kind of came up with as an idea of when it will behoove you to kind of make sure that you're staying in. And that can be very important, so that you're not going to get shaken out at every little wiggle that's coming up. So again, let's go ahead and start out with the back to the basics, the follow-through day itself. And I'm just going to start with some basic definitions, right? The follow-through day concept, it starts with a rally day on a major market index after a downtrend. And one rally day isn't enough. You have to have a confirmation of that strength. And I always think of it as geometry, right? With geometry, 2 points are required to make a line. And if you're going to have a line that says you're in an uptrend, you need that second point. That's what I think of the follow-through day as, that second point that tells you, oh, you've got your rally day, you've got your confirmation. Yes, you are in an uptrend, or a potential uptrend, I should say. And of course, that confirmation comes on day 4 of the rally attempt or later. There are some exceptions where we have a day 3, and that's when there's just so much power on day 1, day 2, and day 3 that Bill said, hey, this is something special and we're going to treat it different. As I said, the man had a lot of exceptions. Now the rally remains intact as long as it stays above the low of the rally. But look, not all rallies are created equally. Some are, great, powerful, life-changing potentially for you if you get the right stocks and you handle them right. Others, it's kind of a lot of back and forth, while others, like we've seen recently, these rally attempts are often failing very quickly. And, it doesn't mean that you should be really playing that heavy in them at all. And that's another thing that people need to understand. A lot of times when we talk about this follow-through day concept, it's not you should be getting 100% invested on day 1. This is where kind of our idea of using multiple buy signals and sell signals to kind of bob and weave and bend with the breeze really helped kind of ramp up exposure when things were looking good and back away when they weren't. And then, of course, there's this whole idea of it's not just the market indexes. Most of us are trading individual stocks. So what are the individual stocks doing? How are they setting up? And all of those things that come into play. So we'll just real quickly take a look at this 1974 example. And I think Bill O'Neill used this in his 24 Essential Lessons book, which originally was from the paper, a series that he did and eventually turned it into a book. So you can kind of see right here, we have a rally attempt and there's the low of that rally. we get a follow-through day on this day, and then it quickly fails. It rolls over. So hopefully you maybe did a little bit of dabbling in. You never really made progress. And so by the time things rolled over, you probably had some sell signals on your individual stocks that got you out, and then the rally failed, and hopefully you didn't get too hurt. But then we have another rally attempt. And again, we have a follow-through day. Again, on the fourth day. Now this one is one that worked. You know, you had heavier volume than the day before. That's one of the requirements that we look for. And you had power on the day. You know, so at this point, Bill O'Neill was using 1% back in 1974, and you had well more than that in this case. So here's another one, October 1998. By the way, this is one I remember very well because I had gotten a follow-through day back in September of 1998, and that one failed. And so when October 1998 came, I was like, oh no, you're not going to fool me this time, and I missed out on it. So I was late. I was playing catch up, and I was buying things a little bit extended. Now in the late 90s, you could get away with it, right? Because you know everything was going up, but it certainly gave me some bad habits at that time. And I quickly learned that once I started working for Bill, how I had missed out on some of the earlier opportunities that would have given me even greater gains and allowed me to hold some of the winners I had for much, much longer. So here we have this case where we had a rally attempt right here, a rally day, quickly doesn't go anywhere. There was no follow through. Then you have another rally day. Now this is what we call a pink rally day. What do I mean by a pink rally day? Well, it closes down for the day, but it closes well off its lows. A lot of times you're going to see it in the upper quartile, but for our purposes, we used the upper half. And usually there is a little bit of a capitulation, right? A shakeout. And that can be positive, and a lot of times that can be day one of a rally attempt. Now, in most cases, when you're counting 4 days, it doesn't matter because you have a blue day eventually, a day that's up that can count as your rally day. So there's very few cases where it matters that you have a rally day start on a pink day, but there are a few examples. In 1982, August of 1982 would be one, and you can find that in the book, How to Make Money in Stocks, in the market chapter. But we wanted to make sure that we weren't missing any of these, and that was also something that was very important to Bill. So you get that pink rally day, and then pretty soon here you are. You're jumping up 2, 3, 4, and you get on the 6th day, you get that power. Again, a strong day. You've got volume heavier than the day before, and this was a great run. You had Charles Schwab coming out on the day of the follow-through day, and that had a 400% plus gain in the next 6 months. America Online came out I think a week later, maybe 2 weeks later. That also had a 400% gain in the next 6 months, and they both basically climax topped within a week of each other. So some of the benefits of the follow-through day, waiting for confirmation of strength can keep you out and on the sidelines a little bit longer, because when you just get one day and it quickly fails, it doesn't drag you in. You just kind of know to sit on your hands. And another benefit is that no new bull market starts without one. We went through all sorts of different charts, looked at the different indexes, and pretty much there was a follow-through day that would have gotten you in pretty close to the bottom in all of these cases. Not at the bottom. I want to be very clear there. Not at the bottom, but within days or within a decent percentage. Sometimes in more volatile markets, that percentage could actually be pretty great. Sometimes 5% or 10% even from the bottom. But a lot of times in those more volatile time periods, it's because the market had come down so much and your bounce was greater too. So giving up 5 or 10% actually wasn't the end of the world, because it was a market that went up 80% over the next year. So that's not too bad if you are giving up a little bit to be a little bit more confident that you're going to be right. So no new bull market starts without one, and it can be a very unemotional signal. Then that can help a lot when a lot of the news is negative. I mean, going back to that October 1998 example, man, you had long-term capital management going belly up. The Fed was going to have to bail them out. You had all sorts of Russian currency crises going on, debt crisis. You had, things, trickling over into Indonesia and, a lot of Southeast Asia. There was a lot of negative action going on, but you had that follow-through day. In fact, I remember when I first started working for Bill, It was September of 1999. And the first time I ever brought him to the airport, Bill was as bearish could be. He had said, look, we've been running for a long time. And I just sent a note to my clients saying, look, I think we're due for a major correction. This could be a big one. And he sent this note to like 500 clients about how bearish he was. So fast forward just a couple weeks later after that drive to the airport, and Bill's buying stocks. And I asked him, like, you were so bearish. Why are you getting in so heavy? He's like, what do you mean? We have a follow-through day. It was almost like he didn't even remember the conversation because it was just so ingrained in him to change with the market. So it can be very unemotional, no matter how negative you are. When you get that signal and you see things lining up, the individual stocks, you see more feedback coming from the market telling you that you can increase your exposure. That all is a way of telling you, hey, the market is shaking off this news. The market is looking forward, and things are, looking up for the market. So I certainly know that helped me in April of 2020 when the market had its follow-through day, April 2nd for the S&P 500, April 6th for the NASDAQ. And I was stunned. I couldn't believe it, and I did some buying, and I'm glad I did, because over the next couple of weeks, a lot of things started breaking out. And it was one of my best years ever that I would have, if I had just gone by what I thought, I would have been like, look, we are in the middle of a pandemic. And, in hindsight, of course, all the liquidity and stimulus and everything that was getting thrown at it, it makes sense that the market went up so much. But at the time, it was really hard to kind of get away from those negative emotions and headlines that were everywhere. The follow-through day just really kind of helped me put all of that aside and just focus on what that technical action was. Now, there are limitations, of course. They don't all work. And the ones that do, they don't go straight up. You can have severe corrections that might have multiple failed attempts. And we generally trade stocks, not indexes. So sometimes there can be a little bit of a disconnect between what's happening in the market indexes versus what's happening in the individual stocks. So let me just, by way of example, let's go back to that 1974 example. Now, this is the S&P 500, and this is that follow-through day that I showed you. And yes, this did work. It had a nice gain. It was up about 13% from that follow-through day to the top here at 77.41, just about a month later, a little bit over a month later. But man, this was a pretty nasty correction here. Over the next month, it corrected 17% from that peak to that bottom at 64.13. So that's not easy. 17% is a pretty big drop for the S&P 500. So they don't go straight up. And Bill used to always say, like, look, they're not going to hand you the money on a silver platter. This is where you have to kind of have your rules in place to know how to play these things. So it's important to kind of realize that it's not just a automatic buy and you don't have to think about anything. There's still, again, these nuances. So let's define some of the terms. And the first one seems pretty easy. Which index do you use? Well, Bill at first was using the Dow Jones Industrial Average because that's kind of what everyone was using, right, for a long time. That's really all there was for a while. He then gravitated more towards the S&P 500. It made him a little uncomfortable that the Dow Jones Industrial Average only had 30 stocks. The fact that it was price weighted meant that sometimes you could have what he felt like was manipulation, where buying would happen in one of the stocks and it would kind of throw the Dow Jones Industrial Average into looking maybe more powerful than it actually was. And then of course the NASDAQ Composite started hosting a lot of the growth names that were on his radar more and more. And so he, started gravitating towards the NASDAQ Composite. And that's why he came up with this whole idea of it being representative of the new America, that N in CANSLIM that's so important. He found that a lot of those companies were on the NASDAQ. So he started gravitating a little bit more towards the NASDAQ Composite. But I will tell you that there were times where, and he's sitting down with Chris Gessel, who was writing the big picture a lot of times 20 years ago, and he was saying, hey, look, maybe the NYSE Composite had a follow-through day on this day. Maybe the S&P 600, the small cap index. There was even one time where he was saying, I think I see a follow-through day on the IBD 50. We had a price weighted index that we would keep track of for the IBD 50. And he's like, I think I see a follow through day here. So a lot of times he was looking for reasons. If he saw enough stocks moving and enough things happening, he would often be looking for reasons to get in. And so I did see him use other indexes, but for the majority of the time, you're really talking about the big three: the NASDAQ Composite, S&P 500, Dow Jones Industrial Average. And this is something that Chris Gessel, our chief content officer, often says is the error of omission is sometimes worse than the error of commission, because we'll often call a follow through day, even if it may not have exactly everything right, as long as it has the letter of the law there, we'll call it, even if there's things that are missing, because we don't want to miss out on anything. We can always put caveats on it, but we want to be aware that the follow through day signal did happen, and we can always adjust accordingly if there's some strength that's missing. Now, of course, you also have to think about what is a downtrend. Our initial studies that Bill O'Neill did, over time tended to be from the more severe corrections after, after he had been through a major bear market. And that kind of evolved over time, because sometimes he wanted to kind of give himself a signal for when you had an intermediate correction or pullback. And a lot of times he would see follow through days there, and especially when we started writing the big picture and kind of came up with our methodology of, we're going to say confirmed uptrend under pressure, or market in correction. There were times where he felt like, hey, the market is in a corrective phase. And then you needed something to tell you, hey, it's time to get back in. So he started using follow through days in a little bit of a different way than he had originally posted in his first edition of How to Make Money in Stocks. But that's kind of where we came in with the market school rules to kind of see how all of this played out. There were times too where the volatility of like the late 1990s made these average percentage calculations tough. When you say a correction, there were times in the 1990s where 10% moves were happening all the time. And so that made it tough to say, oh, this is a correction, as opposed to, hey, this is just almost a regular day of volatility for the index. We eventually settled on, kind of the 21-day moving average line as a line in terms of, hey, there is a corrective phase here, not necessarily a full-blown correction. But even that had its flaws, because, sometimes you didn't have that much of a pullback. The 50-day moving average line was a little bit better, but there were some cases where we wanted to use the 21-day. So, the downtrend, it's a little hard to sometimes say, is this enough of a downtrend to say that you need a follow-through day? That can be a little tricky, to be honest. Now, why do we wait until day 4? This is important, because some of the most powerful days occur during bear markets. And that's why it was really important to Bill to have that confirmation. And just by way of explanation, here's the top percentage gains of the NASDAQ Composite since its existence, back in 1973, the data that I have going back to 1973. So you can see that there were, a 14% gain in a single day, 11.8%, some really big gains. But maybe you notice something about these dates: 2001, 2008, 2000, 2008, 2020, 2001, 2001, 2020, 2000, and 2000. These all were happening during major bear markets, right? So our most recent additions, of course, come from the COVID crash. On March 13th, I think we had a drop of we had a gain of 9.35%. And on the 24th, we had a gain of 8.12%. But, these other ones in 2001 and 2000 did occur during bear markets for the most part. Now, I did highlight in green May 30th, and we're going to talk a little bit about this particular follow-through day, because that was a follow-through day. So it had a very big gain, 7.94%, but it already had kind of the rally, and this was kind of the confirmation of that. The other two that I have in yellow, these were kind of on the border. There was a follow-through day that happened before, so you were kind of in an uptrend, but there weren't many signals happening at that point. So it was a little iffy in those cases, but you did have a follow-through day prior to those, and you hadn't had a rally failure yet. So we'll talk a little bit more about the 2000 to 2003 bear market in a bit. So how much is enough? How much is enough for price? And this is where it again gets really difficult, because if you look historically, that percentage change of what's happening in the market, sometimes you're looking at a chart and a 1% day sticks out like a sore thumb. It's like, oh, that's a day of power. Other times, like right now, for instance, a 1% day, I mean, that's just a very ho-hum day. There's a lot of days that are going up or down way over 1% in a day in terms of just the percent change. So just kind of taking a look at the 50-day average price of the percentage change for the NASDAQ composite, and I just went back to 1995 because, again, 1990 is certainly the late 1990s. You had a lot of volatility, but there are still times where that volatility can get very low. So you have times like between 2% and 3% of the absolute percentage change, either up or down. And you had those in 1987, 1998, 2000, 2001, 2002, 2008. In fact, let me tell you, it was over 3% for 2000, 2001, 2008, and 2020. So that meant that the average day over the prior 50 days was over 3% in terms of the absolute percentage change, either up or down. That's a lot of volatility, right? Now, on the flip side, there were time periods where 0.5%, you weren't moving more than 0.5% on average. 2006, 2012, 2013, 2014, 2016, 2017, 18, 19, 20. All of these periods of time had these very low volatility moments where, over the prior 50 days, you just weren't moving that much. So the low volatility isn't something that was kind of just something of the past. We still have had some of these moments where there's been very low volatility, very low movement in the NASDAQ composite's price percentage change. So what do we do with that? Well, when we were kind of talking with Bill and trying to nail him down on, hey, what makes this a day and not this a day? We just really had him look at charts and say, okay, identify the follow through day for us. And he would, and then we kind of put it into our spreadsheet. And we noticed that a lot of times, for when it was lower volatility, like less than 0.5% that it was moving, the NASDAQ was moving, a lot of times he wanted it to be a little bit stronger, right? But if there was very high volatility, sometimes he didn't need it to be at average because he didn't want to miss anything. And during some of the worst bear markets, the volatility got so extreme that if you had said, okay, it has to be average, well, then you were looking at, oh, you're not going to call a follow through day unless you're 3%. And he was looking at some of that prior downtrend where it was like capitulation. And he didn't want to necessarily count that in the same way that he was counting the power up. So when we were doing kind of all these figures and everything like that, I was actually showing someone who was in one of our more advanced seminars, and he kind of was taking a look at it, and he helped me out with some things. So first, let me just show you what some of this high volatility looks like. This is a monthly chart of the NASDAQ, and I've kind of highlighted some of these high volatility, like 3% or more that you're seeing in these percent changes. And of course, the most recent was in 2020, but we're also seeing it get up there even today. So we've had some moments where it's gotten up to that 3% level for over the last 50 days. And then you had some of these low volatility time periods, like in 2006, right in here at the end of 2006 and 2013. And again, there were moments all along in here where you had this low volatility. And then this 2019 as well, there was moments in there. And this right here, this 2016 to 2017, a very low volatility time period. The NASDAQ, was not correcting much at all. The S&P 500 during this time corrected no more than 3.4% at any point. So that was a very low volatility where there just wasn't much happening on either way. But getting back to, okay, so what do we do here? Well, one of the people was an engineer, and he said, it looks like what you're doing is you're basically using a square root. So he ended up kind of testing some stuff out, and he likes using a root of 0.6, so not quite a square root, but a little bit less. And what that does is when you're below 1%, it kind of makes it so that you have to have a little bit higher. And as you get above 1%, that blue line is kind of, if you were just doing a factor of, okay, you've got to be the average, you could have some periods where you're requiring 3.5% for your follow through day. But again, that's not always realistic. So this was just one way of kind of adjusting it. And we kind of played around with it, because at the end of 2000, or I should say 99, is when we really noticed that Bill was changing that percentage gain requirement a lot. And sometimes it would be on a daily basis. He's like, okay, you know what? We don't need just 1%. We need 1.25%. You know what? I feel like we need 1.7%. In fact, we printed some books with that new figure, 1.7%. And then he quickly changed it and said, you know what? I think we need 2.1%, then back down. So here again, the error of omission is worse than the error of commission. So for our purposes, we ended up going with a lower threshold in a lot of cases because we didn't want to miss anything. And there were sometimes that was at the direct order of Bill. You know, I'll show you a little bit later this August 2007 example where we were taking a look, and you know, we came up with an idea that he wanted this in there, and we kind of had to say, okay, what would make it, you know, fit, because he identified it and he did it real time, but we wanted to make sure it kind of fit with our model. So there's that element, the price percentage change. There's also the volume power. You know, what kind of volume do you need? And you know, you just listened to Dr. Eric Wish. He actually kind of wrote at one point, and he was saying, hey, why is Investors Business Daily calling some of these follow-through days that are on below average volume? And he was quoting the book, you know, because Bill kind of said, you know, you really should have power in both the price and the volume, and it should be above average. But in practice, this is where, again, he didn't want to miss anything. So there were a number of times where you could have below average. Now, he always wanted to see it above the previous day, heavier than the previous day. And he really kind of focused on that. And that's what he told a lot of us in the newsroom, you know, for the seminars, that it really has to be above that previous day. And there were these cases, a number of them, where less than average was still enough. And sometimes there was something going on, some caveats, but here were just a few that he wanted to count. So October 14th, 1998, this was what we use as our example. The NASDAQ composite actually had, and you can see it right here, lower volume than average. Now, the S&P 500, just so you know, it was actually closer to average. So this is where, again, it gets tricky, because one time one average might show something and the other average doesn't. So sometimes you're going off of one average as action, but then the NASDAQ became the stronger index. And so we kind of switched to using that more. We've been seeing that many times where even the Dow Jones Industrial Average sometimes was having a follow-through day, and we were using that as our, you know, our confirmation. And then growth came on a little bit later, and we would switch to using the NASDAQ as kind of our market index that was telling us what's going on. Here's another one. You know, this was May 30th, 2000. And again, a lot of people think of the top in March of 2000 as being like that was it, but there were some tradable rallies, and this was actually a very powerful one. On May 30th, right after the holiday, you had this very powerful day, that Tuesday after the Memorial holiday, and it was below average, but much heavier than the prior trading day, which was a Friday before a holiday, but below average. And this went on to make some very nice moves. And you had SDLI, Keithley Instruments, a big move in fiber optics, JDS Uniphase and Corning. Sun Microsystems was, you know, having another run during this time. So a lot of these tech names didn't actually top. Many of them did top in March, but there was another run in a lot of these names in that May to like September time period. And then here's another one. This was in December of 2011. And of course, it was a holiday time period. You had Christmas right around the corner. But this was after you had a lot of these global recession fears going on, a lot of back and forth, a lot of sideways action over the summer of 2011. And finally, we got the follow-through day. It was a 17th day. It was a little weird because we hadn't undercut this day. But, you know, Bill started counting again because we had really kind of had so much destruction here. He started counting again. And on the 17th day, he said, oh, okay, this is a follow-through day. And even though it was below average volume, he still wanted to count it. So some other ways to achieve power, subsequent follow-through days. This is a big one where, again, if you start seeing days that look like follow-through days that happen after the follow follow through day, that's just giving you more and more confirmation. So here's some examples. That May 30th, 2000 example, it had like six follow-through days, within a 25-day window from the bottom. And in 2001, there was a very powerful rally in 2001, 7 follow-through days there. The actual bottom in October of 2002, there were 7 follow-through days after that. March 18th, 2009, this was after the great financial crisis, there were 6. And these are just a few. There's a lot more where subsequent follow-through days are scattered throughout. But keep in mind, they don't always work. And we saw that, pretty recently here, where we had some, subsequent follow-through days that failed. And I'll show you some of those a little bit later. But here's some examples that we can look at. But I want to just bring us back to this whole idea of balancing the scales. You're kind of taking the good parts and the bad parts, and you're kind of doing a count. This is what Bill often did with individual stocks. He would take a look at, and it was called the red week, the red week, blue week count, right? How many red weeks are there on heavier volume, and how many blue weeks are there on heavier volume? And then he would take a look at the weeks themselves and kind of paint a picture and say, okay, well, this week was red, it was down, but it closed in the upper part of the range. It was a widespread that looked like supporting action to me. Something could be blue with heavy volume, but if it was a downside reversal or stalling action, churning action, that would be a negative to him. So in looking at all of the weeks in a base, he would kind of form a picture of how much was positive and how much was negative going on in that base. And we kind of do the same thing with the markets. So subsequent follow-through days, those are generally good. Follow-through days, when they're undercut, those are generally bad. Early distribution after follow-through days, those are generally bad, but there are exceptions, and I'll show you some of those. So here's a follow-through day that we had back in that October 1998 period. So first, I'm going to show you the one that I played, and this was the September example, where I went into the market on this follow-through day and very quickly got distribution, and then it rolled over shortly after. So this is an example of where that early distribution was a signal that, hey, this might get into some trouble. Now, of course, we had the follow-through day that I pointed out, and though this was below average on the volume, it was still above the previous day, and you had multiple subsequent follow-through days. So these all counted as, if that follow-through day, that first follow-through day hadn't happened, any of these would have counted. So again, it's just kind of that confirmation over and over again of the power that's going on. Here's that follow-through day in March 30th, not March 30th, May 30th, 2000. So you had the follow-through day, and then you immediately had a distribution day, right after that, but you powered higher and had multiple subsequent follow-through days within a short window from that bottom. So again, this is one that worked pretty well. Here's one that surprises some people, is after the 9/11 tragedy, there was actually a tradable rally. So this is showing where the market was closed for 4 days as we were just reeling from the destruction that happened in New York and the destruction that was going on in a lot of the fiber optics and the trunks of communications in the city. And shortly after the market opened, of course, it did go down lower for a few days, but then we had a follow-through day. And it's not like there was nothing out there to buy. Defense names were one of the areas that were showing a lot of strength, a lot of relative strength. They were breaking out of patterns, and you had multiple subsequent follow-through days following that. Here's another one. This was in October of 2003. And this was actually a follow-through day undercut. So what do I mean by a follow-through day undercut? You had the follow-through day the follow-through day itself getting back above the 50-day moving average line. And then the next day, when you close below the low of the follow-through day, that is often a signal that rally is in trouble. But in this case, we immediately turned around. So again, if you're looking at these balancing of the scales, you're looking and saying, hey, there's a lot of power here, and that shouldn't be ignored. Here's just kind of a quick thing that I did, and I did this with Arusha on my podcast just a few weeks ago. We went through the 2000 and 2003 bear market, and there were about 20 follow-through days. Scott St. Clair one time on IBD Live mentioned this. He kind of threw a number out and he said there were so many follow-through days that didn't work during that bear market. And he's right. And in fact, a lot of times you got an undercut, a follow-through day undercut pretty quickly, or you got distribution very quickly afterwards. You got a distribution day within the first 3 days after the follow-through day. And a lot of times that does lead to further destruction. This was something that Chris Gessel pointed out at one of our master's programs years and years ago. There are those cases, like I showed in 2002, where that bottom did end up working. You did have a tradable rally from there. But for the most part, you can see that there's 6 in 2000 where that undercut happened shortly after. There were a few in December even that had distribution in that first 3 days. You had 4 of those undercuts that happened shortly after the follow-through day in 2001. And then you had another 4 in 2002. Now, some of these, they didn't have the undercut for a while, like that March 4th, 2002 example. The undercut didn't happen until 21 days, but it peaked very quickly, and then it was just kind of grinding lower, never really making progress. Same thing happened in August of 2002, where it just was grinding lower after peaking very quickly. And the undercut eventually happened of the follow-through day within 13 days. And a lot of times that follow-through day undercut, when you close below the low of the follow-through day, a lot of times that does lead to a failure. And this is something that we kind of discovered in market school as we were looking. And we actually had Eric Kroll, one of our market school attendees, kind of do a lot more analysis on successful and failed rallies. So what makes for a successful follow-through day, and he kind of quantified some of this. What is success and what is a failure, and he kind of quantified some of the basics of these signals. And he came up with that a follow-through day undercut leads to an eventual rally failure in 90% of the cases. Now there are those 10% again that work, but we'll get a little bit more into some of those odds later. Now there were some tradable rallies, as I mentioned. So there was that May 30th, 2000. Indexes were up 24%, but remember, we're trading the stocks, and some of those stocks had huge gains, whether it be Corning, JDS Uniphase, Sun Microsystems. There were just a lot of big moves. August 17, 2000, there was an 8% rally. Hard to call that roaring success, but maybe you could have made a little bit of money. January 9th, 2001, this one was tricky because, the follow-through day was in a weird position, but there was a 19% rally from there. In April of 2001, you had a 26% rally. And again, this was one where there were some tradable stocks. There were a lot of home builders that were breaking out at this time, Pulte Homes, NBR. So it wasn't like you didn't have anything to buy out there. And then there was that example that I showed you, surprisingly. And again, you look at all the destruction that happens around it, and it's hard to believe that this was actually a 40% rally from that September low till its peak in January. A very quick 40% move. And as I mentioned, there were defense stocks, a lot of things that were going. And now the October 15th, 2002, as I mentioned, that had a follow-through day undercut the very next day, but then you saw all of that power come in, all those subsequent follow-through days come in. And so it kind of negated that negative action. Here again, we're balancing the scales. The positive outweighed the negative. And Bill was buying eBay. That was one of his big winners of that market cycle. He started buying that in October of 2002, and it really didn't do anything wrong. So even though the market kind of came back and pulled in a number of times and really didn't start going until March of 2003, he had one of the best winners for himself early on. And here's that March follow-through day. This is March 2003, and you will notice that there was a distribution day within that 3-day window. But let's look at that distribution day a little bit closer. I mean, look at how it closed in the upper part of the range. So yes, it was technically distribution. It was down more than 0.2%. You could argue, well, gosh, the volatility, maybe it should have been a higher number, a higher requirement at that point. And also, look at how tight it is relative to the action around it. So again, this is why we came up with 20 different distribution day rules until Bill said, okay, guys, enough is enough. Quit making it so complicated. But that is an example where the distribution just didn't have a problem there. And here again, you had a lot of subsequent follow-through days. Another example, this is in August of 07. I mentioned that there was this day where it was just a 1.25%, barely even 1.25%. The volume was well below average, but again, this is one that worked. And in fact, I remember, Mike and Charles and a lot of the portfolio managers were struggling for a good portion of the year. We had the market start off, pretty strong, and then you had the Shanghai surprise that knocked a lot of people out. It seemed like it was rallying back, and then you just really kind of got into choppiness, and then you had a lot of hedge funds running into trouble in the summer. But after this August follow-through day, a lot of the portfolio managers went from being barely up to having 100% gains for the year, because you had you had the fertilizers going, you had Crocs, you had a number of solar stocks, First Solar, SunPower, you had the shippers, the shipping move that we're seeing now in the last year or so. That's not new. You had a bunch of those shippers, Diana Shipping and all that were having these moves in 2007 as well. Very strong moves, the fertilizers, and some of the commodities as well. So very powerful move there. And again, a lot of subsequent follow-through days that were giving you more and more reasons to say, hey, the market indexes are telling me that there's a reason to dole more money out, as opposed to those negative signals that tell you, hey, maybe I need to pull money back in, or the individual stock signals that tell you, hey, I need to maybe get a little bit more defensive here. Here is in March of 2009. So this was after the great financial crisis. Now, I'm pointing out where the NASDAQ composite had its follow-through day right here, but the S&P 500 actually had its follow-through day a little bit earlier, and that does happen sometimes. So, the NASDAQ did have distribution shortly after its follow-through day, but then again, you had all of the subsequent follow-through days that were kind of telling you, hey, there is power behind this. So again, it's important to kind of remember that we do trade those individual stocks over the indexes. So a few things. If there isn't merchandise to buy, that is telling you something. And I think that's been one of our biggest complaints in the current market environment, is that we keep on seeing, hey, there's just not that much to buy right now. And that's, that's kind of a problem. Another thing is that the strongest uptrends tend to have stocks clamoring for your attention. It's not like, oh, I'm really scouring to try and find stuff. It's like a lot of things are jumping out at you and saying, it's almost, you have the problem of having to be selective, right? Because there's so many things that kind of look good. That kind of defines a stronger market. But again, that's hard to quantify, because each market is different. You have to have kind of what stocks were moving, and how many stocks, and how do you quantify that? How many stocks were breaking out of sound bases, and with the CANSLIM criteria, the fundamentals, the current earnings, the annual earnings. That's where it does get tricky. And again, back to that kind of three-dimensional chess idea. But here's an example from the March 2009. Again, after the financial crisis, you had the indexes well off their highs, 57% corrections in the S&P 500 and the NASDAQ composite. But at the bottom, you started to show some relative strength in a lot of names. Apple at the time, whereas the indexes were undercutting their lows in March, Apple wasn't. Neither was Amazon, neither was Ctrip, neither was Priceline, neither was Baidu, neither was Chipotle Mexican Grill. And you can see that in this window of the follow-through day, this is where some stocks were breaking out beforehand. They were showing signals beforehand. Some were showing it in the weeks after, but there was a lot of stocks out there to buy. This is just some of them. Let's talk a little bit about staying in. I'm going to kind of wrap this up with some of the ideas of staying in a market. And one of the things that we kind of felt like told you that, hey, this is a market that maybe you want to slow your selling down. And especially, look, when I first started working for Bill, granted it was in 99, And then I saw 2000, and I saw him sitting in cash for long periods of time where the market just didn't look right. I saw him go short a few times where he was playing some of the stocks to the short side. But for the most part, he was sitting on his hands through a lot of that, dabbling a little bit, but then quickly backing away when the market just didn't look right. But then there are these other time periods where he would be very hesitant to get rid of his stocks. He wanted to give them extra room because he had so much cushion that the market might have been pulling back 10%, but it had so much room that it had gone. Given the context of where it had been, the correction seemed within reason, and sometimes it wasn't even getting below the 50-day moving average line, or it would get below the 50-day moving average line and come right back. So we kind of came up with some rules that told us, hey, this might be something that's a little bit special, and we might want to just hold on for longer wherever we can, especially our leaders, be a little bit slow to sell, and maybe be a little bit slower to go 100% in cash. And a couple things that we looked at: 21-day moving average, and we use the exponential 21-day moving average line above the 50-day moving average line. We like to see it at least above there for a few days. Sometimes if you just allow for one day, you can get some noise as it goes back and forth. So we wanted to see like at least 5 days. We wanted to see the price of the index trending above the 21-day moving average line. And we also wanted to see that 50-day moving average line having turned into an uptrend. This was something that Charles Harris kind of added because it's something that he was looking at for some of his stocks and indexes. He wanted to kind of see that the trend had changed and the 50-day moving average line was back in an uptrend. Just had to be 1 day, but at least it was on that turn. So here's a few power trends of the last 20 years. And I came up with some of the longest ones. There's certainly more, but we'll go through a few of these. In 2000, before it peaked in March 10th, that was a pretty good power trend that was going on, even despite the volatility. That 21-day moving average line was staying above its 50-day moving average line. You had the same happen in 2003. So I'm kind of showing the end date of when the power trend ended. That doesn't necessarily mean that's when your exposure would have gone to zero. Sometimes you got sell signals earlier that were kind of pushing you out. But again, these were some of the longer periods where that trend remained intact. After the March 2009 example that we looked at, you had a really great rally there. September 1st, 2010, there was a great power trend there. We talked a little bit about that December 20th, 2011 example. It was a very short rally, kind of peaked in March 26th, but that was a very quick power trend that happened. And there's more, 2012, 2013, 2018, this one was one of the longest that I've ever seen, from kind of the election in 2016, November of 2016, kind of turned the tide. The market was getting stronger and stronger. And that was that really low volatility period through much of 2017, where you didn't have the S&P 500 correct more than 3.4%. So that was a very long period. And we've seen some long periods, even more recently. Before COVID hit, going up into February, we were in a pretty decent power trend during that. And then it got really kind of extended. And then, of course, the COVID news came out. September 2020, from April or May of 2020, after the follow-through day, we had some really strong action going on. And then even in 2021, after the market kind of settled down after September and October of 2020, and then we had Vaccine Day in November, the election in 2020, the presidential election in 2020, you did have another power trend. So we'll take a look at some of these and just kind of show you what it looks like. So here's the one in 2003. This is the March 2003 example. You had, again, kind of a 3 waves down. This was the 3rd wave down after the October bottom. Here was your, distribution that day that we talked about that didn't really look like distribution. And here was the power trend. At this point, we finally had the index trending above its 21-day. The 21-day was above the 50-day well before that, but you got all of the elements in here in that you were trending above that 21-day moving average line, and the 50-day had turned back into an uptrend. So this actually is one of the later starting ones because that dip below the 21-day there. But look at how powerful that was. It had a few dips below the 50-day moving average line, but not for very long, until this one is where the power trend finally ended, and you saw that 21-day moving average line fall below the 50-day moving average line. Here is the March 2009, after the great financial crisis. This one was pretty quick to trigger. And again, you had some moves down below the 50-day moving average line, but that green line, the 21-day exponential moving average line, really remained above that 50-day line until right there. So keeping you in for a longer time, or at least telling you, hey, give your stock some room, try to hold on to them if you can. Here was that long period that I told you about. This was the election in November of 2016. And look at how this just kind of hugged that 50-day moving average line, never really corrected all that much. Very, very strong power trend until we had kind of that volatility crisis. Remember that with some of the ETFs that were trading on volatility. You had that issue go on in February of 2018 that kind of ended that power trend. Here's another one, the April 2020. As I mentioned, there was kind of this negative action here. This was actually a distribution day shortly after, but remember, we had the S&P 500 that did have its follow-through day earlier. It just wasn't in the right position for the Nasdaq, or maybe the volume wasn't there, but you did have it on the S&P 500. And the power trend, it did start a little bit later on the Nasdaq. Again, once you had that 50-day moving average line, that was kind of one of the final things it was waiting for. But that was pretty powerful there. And then here is that example from, just one second. Let me go back up real quick. I wanted to show a few examples of some of the stocks, because again, one of the things that we have been struggling with lately is that there weren't many stocks to be buying. I mean, yes, you had some setups in the utilities and in the food, confectionery and packaged food and the meats and a lot of these defensive areas. Now, certainly you had earlier in the year a lot of the commodities setting up. And again, that was a little weird, right? Because you had the indexes going down, but this whole area of the market that was, really coming on strong. But then eventually those started, getting the rug pulled out from under them. We saw a lot of those commodities, oil and gas, coal, the copper, really struggling, especially as recessionary fears, started taking hold, and shutdowns in China and everything like that. So now we're kind of stuck with, not very many things setting up as we typically see. And that's very unlike what we saw after the COVID crash. That was something that was pretty remarkable, is once you had that follow-through day on the indexes, again, April 2nd for the S&P 500, April 6th for the NASDAQ composite. Look at this chart of NVIDIA. It's like a perfect cup with handle. And the follow-through day happens right as it's finishing its handle. Here's Microsoft that was finishing a double bottom. It was coming up on the right-hand side. So, I feel like, around not March 14th, April 14th is when we really started going very heavy in many of our products, leaderboard, swing trader, me and my own portfolio. After having some success, things were working. A lot of these setups, and again, it's not just like it was Microsoft and NVIDIA. You had Shopify, Adobe. There was just a whole host of these tech names that were looking so strong, and their relative strength lines. Look at the relative strength line on Microsoft here. It was soaring. So again, something special was happening with these, and it wasn't like it was the defensive stocks that you would expect if people were really truly, going to be hiding in their bunker, during COVID. You would have expected a very different animal there. Now, granted, some of this was the work from home. You had a lot of stimulus coming. You had the liquidity being offered by the Fed. So in hindsight, it absolutely makes sense. But man, at the time, the charts were kind of telling you everything you needed to see. And then let's go ahead and fast forward to today. So this is Friday's action. What we're seeing today is a lot of these follow through days that are quickly failing, which is good because the quick failure kind of keeps you out of trouble, right? It means you don't have the temptation to be buying a lot. It's telling you very quickly if your stocks don't work and the market looks like it's getting into trouble, it's getting that follow through day undercut. Unless you have some subsequent follow through days come in to kind of counterbalance that, it is kind of keeping you out of trouble. So we had that recent follow through day, actually 2 follow through days in May. We had this March rally where, yes, we did get some subsequent follow through days in this case, but then as soon as we got to that 200-day moving average line, we got turned away there. The follow through day undercut came pretty late, but I think you were seeing early on in April that a lot of the stocks were really kind of getting the rug pulled out from under them. So again, the individual stocks was an important indicator. And then, I showed you that follow through day already. The first one in May. Here's the second one in May. You had this kind of trading range that happened, and it kind of gave you the feeling like, look, we're either going to break one way or the other, either to the upside, above 12,320, or to the downside here, below 12,000. And we got it to the downside and quickly got that follow through day undercut. And we got another follow through day undercut very quickly after the most recent follow through day. Now this one hasn't given up yet. This was also a distribution day, by the way. It hasn't given up yet, but you can see that it did get its head knocked on the 50-day moving average line, coming down a little bit. There are some medical stocks setting up, so we're starting to see some green shoots. We are starting to see some behavior of the market where it's kind of absorbing some of the negative news a little bit better, but it remains to be seen. It's a little bit too early to tell right now whether or not this is truly something that can have a tradable rally. So I want to kind of wrap this up with a little bit of a new analogy for you that I'm trying out when it comes to like these follow through days. Oh, before I get to that, one other thing I just want to mention, because you had David Ryan on earlier today, something that David Ryan and I are going to work on, and he's kind of got a lot of the ideas out there. I just have to kind of test them for him. But we talked about that power trend. One of the things that David Ryan came up with is, hey, in a market like this, should we be talking about a power outage? Or something like that, where you have the 21-day moving average line trending below the 50-day moving average line. And it just means that, either you're on the short side and playing it that way, or you're just a little bit hesitant. You need a little bit more information before you go in too heavy. And that power outage might be something that helps keep us out of trouble. So that's something that I just wanted to kind of, tell you that we're looking into, and hopefully we can come up with some rules and some historical examples of that we can share eventually with our audience, because I know many of you TraderLion folks are also our folks too. So here's my new analogy that I was kind of thinking of. I was reading something just this week, and it was on a meteorologist talking about the percent chance of precipitation, and he was talking about how it's tough as a weatherman, right? You come up with your percent chance of rain, and you've got, let's say you say it's a 20% chance of rain. Well, if it rains, then you've got those 20%, the people that saw your 20%, it rained, they weren't prepared because they were like, well, it was only 20%. I didn't prepare for rain. How could it have rained if it was only 20%? Then if it doesn't rain, you have those people that prepared and they're saying, oh, look, you said it was going to be a 20% chance and it didn't rain. Well, there's a few things. First, what counts as rain? How much is enough to say, yes, we did have precipitation, and they have their levels. But what a lot of the meteorologists do is it's a confidence times area. So for instance, if you have a 50% chance of rain in 80% of a particular area, then they will say, hey, there's a 40% chance of rain. So a lot of people kind of don't understand the way that they're actually referring to the math. Well, how does this work for the follow through day? Well, you have to identify what that success and failure looks like, or what counts as rain, but also what does your area look like? Because I think that's important. It's not just one signal or one day. The context matters. What's happening around that day? And this is something that Bill told me about with individual stocks. Sometimes I was very annoyed that there was a stock that was setting up really great. It breaks out, but there's not volume on the day of the breakout. And then it goes up a huge amount, and I didn't buy it because it had that flawed volume. And a lot of times Bill would say, but look at what was happening around it. It had some volume the day before or the day after. Did you notice that? And that was your institutional buying there. So the context, the area matters around it. And the same thing that we just saw with these follow-through days. What's happening in the area? If you get a follow-through day undercut without any subsequent follow-through days, well, yeah, that's negative. What's happening in the area is negative, and it doesn't have anything to counterbalance it. But on the other hand, if you see a lot of these positive things, that's telling you, hey, there's something going on in the area that is more important. So it's that balancing act, looking at the positives and the negatives. How many days are you looking at? That overall, not just the follow through day, but kind of what's happening before and after, what's happening with the individual stocks, what's happening with the other indexes. I just showed you a number of examples where the S&P 500 was the one that had the follow through day first, and even though growth might have been driving it, you have to kind of look at all of the different indexes, and especially those individual stocks. So hope that kind of helps put some of the nuances of the follow through day, and again, that explanation of our power trend idea, that concept, and if I could just kind of end on a positive note, I know that this has been a tough market for a lot of people, but again, there's been a lot of this negative action and a lack of individual stocks setting up that has kind of helped avoid a lot of the turmoil. And hopefully that's something that if you didn't kind of follow this time, hopefully it's some lessons that you learned for the next time, because there will be a next time, just as there will be another market rally. The things have gotten very bleak before, and you can have long periods of sideways action, but then when it comes out of it, those are sometimes your most powerful rallies. So while 2020 might have been where a lot of people got in and were buying on dips and maybe didn't have the best rules in place, just like I didn't have the best rules when I was playing in the late 1990s, hopefully this has kind of gotten you to a point where you're honing in your skills. You're getting a little bit better at identifying those proper areas, getting a little bit more precise, because this is such an unforgiving market, and that'll just make you that much better when the market does turn. And so I wish that for all of you, and happy trading, happy hunting. Thanks a lot. Richard, hopefully you were checking out in the chat to see if there were any questions. We have a little bit of time to take some questions if you want.
Yep, absolutely. And Justin, thank you so much for this really in-depth presentation. I think it's cleared up a lot of people's questions about the fall through day and how, it's not just a black and white concept. There's a lot of nuance. There's a lot of gray area, which I think you definitely did an excellent job of covering. There were definitely some really good questions. One of them was from Greg Morton, who's asking about that power outage concept. So you already kind of talked about that a little bit. But I'd love to hear a little bit about your ideas for that. What do you kind of look for in your huge Excel sheet to try to decide whether that's worth incorporating as a full system?
Well, the first question that David Ryan posed is, what if we just flip your rules on their head? And so that's what I did. I said, okay, we need to have the 50-day moving average line in a downtrend. We need to have the 21-day trending below it. We need to have the price action trending below the 21-day moving average line. And again, just like you saw with some of those power trend examples, sometimes you will get a late example. It'll kind of be pushed. And so one of the things that he kind of said, hey, let's test out just how quickly we can make this. Here again, it's a balancing act, right? How quick we can make it happen while not introducing too much noise, right? Because what happens a lot of times, if you kind of change one lever, it affects something else. And a lot of times, if you want to get out quicker, that's great, but it usually ends up creating more signals and more false signals. So you have to kind of be careful whenever you're doing that interplay. So again, it's something that we're testing, and he wanted to test it not just on the NASDAQ, because I was able to kind of run the numbers very quickly on the NASDAQ, but still want to run it on the S&P 500 and go back in time even on the Dow Jones Industrial Average. And once we kind of have something that David Ryan is comfortable with, we'll probably be sharing that on our IBD Live program, and I'm sure we'll We'll be probably doing a podcast on it. It'll get out there. We don't tend to. That's one thing I have to say about Bill that I'm just so impressed with. He certainly could have just held all this information to himself, right? But that's not what he wanted to do. He wanted to share it. So that's certainly one of the things that we've continued to do. Is when we come up with information that we think is important for people to know and will help them, we like to share it as quickly as possible.
Perfect. And along those same lines, I'd love to hear about the general process of doing a study. I've asked you about this a little bit before, Justin, but how do you make sure you don't overfit your data and make it so, looking in hindsight, this is perfect, but it won't really apply in the future, or it's a little bit too strict on certain criteria?
Yeah. So it's a balance, right? It's tough because, man, I can look at a chart and tell you all the places where I would love to buy and sell, and it's easy, but unfortunately we have to trade on the right side of the chart, right? We don't get to trade in the middle and say, oh, I know what happens afterwards. And sometimes, I'll be honest, that was something where we were kind of like, hey, let's see if we can trick Bill. We would show him a chart and not tell him when it was and say, hey, is this a follow through day? Is this stalling? Is this distribution? Is this a top? To see if he would kind of call a top in the middle of a great run or something like that. So, what I tend to do is I think it's really important that when you're kind of testing something, you don't just look at an overall performance number, because what can happen sometimes is you look at that overall performance number and you say, oh, I did this indicator and, it improved my performance. And if I change the number, or the indicator, the threshold, it made my performance better. And, you think simply, well, if it made my performance better, it must be good. Not necessarily. Sometimes you look at the instances and it does things that you didn't expect. Or when you look at the instances, you have one case that all of your performance, your outperformance came from. But what ended up happening is you kind of ruined a lot of other areas. So, a lot of times what I was doing is, when we were testing something, I would say, okay, you've got an idea, guys, let me put in this Excel spreadsheet, and then I'll come up with a lot of examples where that happened. And I would start by looking at the extremes, some of the best examples, some of the worst examples. And then again, this is where, we've all been looking at charts for so long. We could kind of take a look and change the date and look at it at the time and say, what would I have, and you have to try and be intellectually honest with yourself. What would I have done during that time period? But it really is kind of that methodical look at, again, your extremes, your averages, and enough of a sample size of your instances to say, yeah, this is something that makes sense, and not necessarily something that just, it gave me the better number. In fact, there were a number of things that we did, and it lowered our performance, but it still made a lot of sense. Just one example in market school, Mike Webster was adamant about using a restraint rule. He said, look, when you first get in, when you first have that follow through day, you really shouldn't get too heavy in until you've got some progress made in the indexes. And so he had this restraint rule that says, okay, don't go above a certain amount until such and such and such and such happen. And we tested the rule, and it worsened performance overall, over the time period we were looking at. But when we looked at when it worsened performance, it was like, no, it kind of made sense what it was doing. It really, it really hadn't, taken off yet. So again, we accepted the lower performance because the rule still made sense and would keep people out of trouble. And it lowered the volatility actually too.
Yeah.
So if we'd done risk-adjusted returns, we probably would have been a little bit happier with it.
Perfect. And as you've kind of touched on today, there's kind of two aspects to a fall through day: the quantitative side of things, which is the fall through day rules. Then there's what are the stocks actually doing? That's kind of the qualitative part of it. Have you done any kind of work to try to quantify the qualitative? I know that's a little bit of play on words here, but like, have you looked at like the market breadth or percentage of stocks above their 21 EMAs? Just trying to see, like, at that instant of the fall through day, what are the stocks actually doing? Have you looked into any of those kind of metrics?
Yeah, and this is where it's a little tricky, right? Because when you look at the market as a whole, sometimes it doesn't tell you the whole picture, right? Or unfortunately tells you the whole picture, but not the minute picture. And
The growth
sometimes that's
stocks,
what's
yeah.
more important, right? The growth stocks are doing something different, or these industries are doing something different. So that's where, again, it gets a little bit more complicated. And, I think of, some of the, the conventional wisdom that's out there. There's studies that show, hey, look, lower PE ratio stocks do better, and it's hard to argue against the data. If you look at the market as a whole, that may be true, and I believe the data that it is. But when you look at the stocks that are the best performers out there, well, then you're looking at a subset, and you find that sometimes the data is a little bit different. And so, to kind of get back to your question, sometimes that can be the trick. Is if you're looking at everything, then you're missing what's happening in certain sectors or certain groups, and that's what's important. So it's tricky. It's tough to quantify the quality.
Yeah. And to some extent, you want to keep it simple. You don't want to overcomplicate things, right?
Right.
Yeah.
But there's certainly, one of the things that we'll do is we'll go back and take a look at, and this is where Praveen Bishoy, who is our programmer, and it's great to have a programmer on our team who loves to trade the market too, right? So he's always kind of doing studies where he will kind of slice and dice some of these things, because he's got the database of stocks where he can say, okay, let me see what was happening in the individual stocks. And, you also have to be very careful when you're looking at any database of stocks that you're, that you have a complete database, because if you're just looking at the stocks that existed at the time, right, you've got a big survivorship bias, and like, oh, you're not looking at all the stocks that don't exist anymore because they're out of your database. You really have to make sure that your database is complete. And so sometimes we'll even go back to old papers and take a look at, what are the IBD 50? What was the IBD 50 full of at that time, or what was in the 85 index, to get a little bit broader. So, and of course that's where things get pretty data intensive, right?
Absolutely. And there's a question from Dennis about, and this is also talking a little bit about the qualitative aspect of things. Is there a minimum amount of setups that you'd like to see to give you more confidence in a fall through day?
Yeah, that's not something that I've ever heard, done quantitative on that quality part. But a lot of times we try to nail down Bill on some of these, and he kind of would give the answer, I'll know it when I see it. But some of that does come from experience. I'd love to be able to quantify that. And again, that's where it gets tricky. Is, okay, what identifies, yes, this was a setup. This was a proper setup. Did it have to have all of the elements of CANSLIM? Well, as most of you know, if you set your screen too tight on your CANSLIM parameters, you could have one stock show up. So what's the right level of screening to say, yes, this was a setup? And this is where pattern recognition really helps too. And Praveen, as I mentioned, he's got those pattern recognition rules, so he can check that as well. So those are some great ways for us to kind of get an overview. But yeah, so some of these answers are a little bit tougher to get at. And again, you almost have to look at the individual stocks too, to make sure that what you programmed actually made sense.
Absolutely. And I want to ask you about kind of your own personal kind of position exposure rules around the fall through day. Do you have specific rules that say I have to buy 3-5% positions on the fall through day? How do you kind of deal with that and make sure that you're shifting your mindset to, now this could be a potential rally that could have legs? We don't know for sure, of course, but I've got to switch that a little bit to that buying mindset.
Mm-hmm. I always try and buy something, and I'll be honest, sometimes if I can't find anything, I'll be playing the indexes,
Mm-hmm.
either with QQQ or a leveraged version, QLD or TQQQ. So, I do try and buy something. But here again, I am maybe a little bit more aggressive when there are more of those, setups. There's more of, where its positioning is, especially if you start seeing things breaking out before the follow through day. Sometimes the follow through day happens and I've already got a few positions because the setups looked good. The market looked like it was coming, going the right way. Or maybe, like in 2018, we had that tough bear market, that was kind of Fed induced, and it just, at a certain point, it seemed kind of overdone. And I know that, that's a terrible thing to say, because I've seen so many times where it looks overdone, and it just gets overdone. Not that that's a word, but I've seen it get worse. But it did seem like, when we had kind of around Christmas time some reversals, it did seem like it was just kind of ready. And so I'll maybe get a little bit more aggressive, but it's important not to go overboard, because that's where I've gotten hurt in the past. 2001, again, I got out. I've told this story so many times. I got out so good in 2000. It was like, I was kind of just really on it. I was observing the climax tops. I got out, and what killed me was how many times you saw there were 20 follow-through days during 2000 to 2003. And I think I played every single one of them, right? And each time it was like, get on margin. Let's go really, it's time to make money again, please. The 90s were so fun. I want to party like it's 1999 again. So I do always try and temper that. And it's hard, sometimes if there are a lot of setups, I do find that I will go a little bit overboard. Still, but again, not anything like I used to. So I have learned from my mistakes to a degree.
Great. And obviously, being the longtime assistant to O'Neill himself, I'm sure you've got some really interesting and fun stories. So what's something that we may have never heard about O'Neill before, but you think is pretty interesting and pretty relevant to this conference?
Okay, well, I was going to share that he often wore a Mickey Mouse watch, but that's maybe not as relevant. Again, I think what many people admire the most about Bill was how quickly and flexible he was in terms of being able to change his mind and, look at new data. And he was also, he approached it with a certain amount of humbleness, for as long as he was doing it. And granted, when I started working for him, he had already been at it for over 40 years, and he still was looking at it as, as great as we did in this run up in the late 90s, how could we have done better? It was always like, what else can we do? How can we manage our risk a little bit better? And even, that was, he implied some or started some rules at that time that were just kind of there because if it had gone the other way, he felt like the risk management was in place. That yes, things worked out, but he, in looking in hindsight, looking at how invested the firm was in certain stocks like Qualcomm, it was a little scary because he said, man, if this had gone, we played it so well, but man, if we were off a little bit, that could have been, really ugly. Or if, one of those black swan events had happened. So, again, I think he was always, trying to learn, up through the time that I worked, for him. And, granted, I hope he's enjoying retirement now because he's really stepped away from the stocks and kind of the paper and everything. He's kind of left that to Scott O'Neill, but that flexibility that he approached it with. And I got it from that first time I brought him to the airport, when I saw, how quickly he was able to change his mind. And by the way, I should say that I drove him to the airport in a Ford Festiva, a little 3-cylinder Ford Festiva. So, he also loved the fact that I was driving a car that was that old, beat up, and got great gas mileage. He's like, yeah, he'd never wanted to buy depreciating assets, and everything. He's like, yeah, save that money for the stock market.
Perfect. And there's a pretty good question here from Green Eggs and Cam. Justin, instead of looking at distribution days after a fall through day, have you investigated or looked at all accumulation days and how that impacts things?
Yeah. And so a lot of times those subsequent follow through days, I mean, those are very clear signs of accumulation. And we do, we kind of, for market school purposes, we called them subsequent follow-through days when they happen in the first 25-day window, because that's where most follow-through days happen. We called them accumulation days after that, if they kind of had all those elements, but we're outside of that window. And yes, that's one of those things that just kind of gives you a little bit of extra confidence in things. Now, I should also mention that distribution days sometimes can be problematic. I can't tell you how many times I've gone through and said, look, here's a market where there's 9 distribution days in a 4-week window, and the market is just not doing anything. It's not going down. That especially, I think, happened during quantitative easing, where the Fed is pumping so much money into the market on a monthly basis that you got distribution days, but the market was like, where else are you going to put your money? So but I will say that clustering distribution is certainly something that we still find to be very relevant, even if distribution pileups themselves over that time period may not be, but clustering distribution is still something that is very negative. And again, a lot of times you're going to see it in your individual stocks too. They're going to give you signs of them getting extended. We have done a little bit more work on the extension part. And again, some of this is from Praveen Bishoy, recognizing when a stock, when an index like the NASDAQ is more than 7% extended from its 50-day moving average line, hey, expect some mean reversion there. So some of that helps too, to kind of know when you're getting at the edges of your bands.
Perfect. Justin, thank you so much for this awesome presentation. I just have one last question for you. What general advice do you have for any traders watching here? What are the key takeaways that you want people to walk away from your presentation with?
Well, I think the one thing that I saw Bill when he was speaking to people that he always tried to end with, and how he signed books, it was always that you can do it. That this is something that anyone can do. Bill was a self-professed not great student in school. He's like, look, I was a C student, but if you're just willing to kind of, again, approach it with humbleness and be willing to learn from your mistakes, first look at your mistakes, admit them, that they were mistakes, and learn from them. Come up with rules to save yourself from yourself. There's so much that you can do to get better and better at this. And while you don't have to necessarily have 1,000% years, if you just can move the needle a little bit on your percentage gains, you can make a big difference in your financial future. And that's what Bill wanted for everyone. And I think it's a worthy goal. So hopefully this helps and gets people on the right path. And even if it's just one thing that kind of crystallizes in your mind and you're able to use it for the next time, that's good enough, because getting better, that's how you keep going. And hopefully this helps.
Perfect. And yeah, we'll look forward to the next power trend. It might be a little bit far away, right, but it could be right around the corner. So we'll be ready. So Justin, thanks again for your time. This was fantastic. And we'll be right back with Tom Basso, Attacking Risk in the Markets. And that will start at 6:10. So thank you so much, Justin. Thanks for all the great questions. And we'll be right back.